Okay, let's unpack this. What makes a company truly sticky? We often think about the products, yeah?
Mhm.
Those things customers just, can't live without, like a beloved brand of adhesive, for example. But what about financial performance? What makes a company's numbers sticky, consistently showing strength quarter after quarter, whatever the economy throws at them?
That's a really good question
Yeah.
because it goes beyond just like product loyalty. It gets into something deeper.
Operational
Yeah,
excellence.
operational excellence, a really solid business model. It's
Ah,
about a company that, well, just delivers reliable, growing results, even when things are tough out there.
exactly. And today we're doing a deep dive into the financial results of a company that honestly pretty much defines sticky in India, Pidilite Industries Ltd.
Ah, Pidilite.
For those of you maybe less familiar, Pidilite is India's leading manufacturer of adhesives, sealants, construction chemicals. We're talking about the company behind Fevicol.
Fevicol, yeah.
hmm
Icon.
It really is. For so many people, it's not just a brand. It basically is the word for glue in India, isn't it?
Absolutely. School projects, home repairs,
Yeah.
it's everywhere.
Definitely holds a special place. So yeah, for this deep dive, we've got their recent press release, the unaudited financials, both standalone and consolidated,
And the detailed earnings presentation.
for the quarter ending June 30, 2025. Got all the key documents here.
Right. And our mission, really, is to cut through the jargon, the numbers, find those crucial nuggets of insight from this quarter. We want to help you understand the key drivers, what really matters in their latest report. So, with that said, what immediately stood out to you? First glance at Pidilite's latest numbers.
Well, I think the first thing that jumps out is just the consistency, especially a profitability side of that growth. So on a consolidated basis, that means, including all their subsidiaries and everything, net sales hit Rs 3,742 crore,
Okay.
which is a pretty solid 10.6% growth compared to the same quarter last year.
2.6%.
Oh.
Okay. And crucially, this isn't just revenue. Their EBITDA, that's earnings before interest, taxes, depreciation, amortization,
Yeah.
basically a core profitability measure.
Right, the operational profit.
Exactly. That increased by, get this, 15.8%, up to Rs 941 crore.
Wow, okay. So 15.8% growth in EBITDA on 10.6% sales growth. That's significant
I,
leverage.
it is. It tells you they're managing things efficiently. It's not just sales expansion. It's, like you said, truly profitable growth from the core business.
Makes sense.
And it gets better. Their profit after tax, the PATT, grew even faster, up 18.7% to Rs 678 crore.
18.7.
Yep. And profit before tax and exceptional items, PBT, that was up 19.1% to Rs 915 crore.
So profits growing faster than sales across the board, really.
Precisely. It suggests, good cost control, maybe a better product mix, something driving that operating leverage before you even get to taxes or any unusual items. They're getting more profitable with each rupee of sales.
And the strength wasn't just in the consolidated picture, right? The standalone results. So just the main Indian parent company, they looked pretty similar.
They did, yeah. Very closely mirrored.
Yeah.
Standalone net sales also grew 10.6%, hitting Rs 3,467 crore. Standalone EBITDA, before non-operating income, up 15.2% to Rs 888 crore.
15.2. Okay.
And standalone PT increased by 17.8% to Rs 650 crore. The percentages are strikingly close.
That really points to the core Indian business being incredibly healthy, doesn't it?
It absolutely does. Strong foundation there.
Now, besides these core financials, the board made some interesting announcements too. Something about the founder and shareholder rewards.
Yes, quite notable. They used the occasion, the 101st birth anniversary of their founder, Sri B.K. Parekh, to approve a bonus issue.
A bonus issue, yeah.
One fully paid bonus share for every existing fully paid share. It's subject to shareholder approval, naturally.
Right, standard procedure.
But still, a significant move. And on top of that, they announced a special interim dividend, Rs 10 per share.
10 rupees special dividend and a bonus issue. That signals a lot of confidence from the board, wouldn't you say? Rewarding shareholders quite directly.
Definitely. Clear signals of confidence and financial strength. And just as a small detail, the report mentions the board meeting itself was pretty efficient. Started at 11:30 a.m., finished 2:10 p.m. on August 6th.
Huh, okay. Decisive leadership, perhaps?
Maybe so.
All right, so interesting shareholder moves. But let's get back to the growth itself. How did they actually achieve that 10.6% top-line growth? Was it just price hikes, or was there real underlying demand?
Ah, that's the key question. And it seems it was definitely more than just price. The crucial metric here is their underlying volume growth, or UVG.
UVG, right.
Overall, Pidilite reported UVG of 9.9% across all their categories and geographies.
Almost 10% volume growth.
Yeah, nearly double digits in pure volume. And that's what's really underpinning the revenue growth we talked about. It shows real demand increase, more stuff being sold, not just higher prices.
And why is that distinction so important? Why focus on volume over just sales value?
Well, volume growth is generally seen as, let's say, a healthier indicator. It means more people are buying your product, you're likely gaining market share. It reflects genuine customer adoption. Price increases can sometimes just be passing on costs.
Got it. Makes sense.
And what's interesting within that UVG figure is the performance of the different segments. The Consumer Bazaar segment, C&B, saw its UVG improve sequentially to 9.3%. Pretty good.
Okay.
But the business-to-business segment, B2B, was particularly strong. Robust UVG of 12.6%.
12.6% volume growth in B2B.
Yes. And importantly, this is the 8th consecutive quarter they've posted double-digit UVG in B2B.
8 quarters. That's 2 years of consistent, strong volume growth in their industrial side. That's impressive.
It really is. Shows sustained demand in those industrial and project-based areas where they operate.
So strong volume growth, how did that translate into margins? Did costs behave themselves?
Well, their gross margins were apparently pretty stable, stayed in line with Q1 last year, which is good considering input costs can always fluctuate.
True. Holding steady is positive there.
But where you really see the improvement is further down. The EBITDA margins improved by 101 basis points.
So just over 1 percentage point.
Exactly, over Q1 of FY25, reaching 25.6% this quarter. That points to good cost management, operational efficiencies kicking in beyond just the raw material costs. More of that revenue is dropping down to operating profit.
Okay, 25.6% EBITDA margin. That sounds quite healthy.
It is, yes.
Now, you mentioned geographies earlier. How did things look comparing, say, domestic versus international operations? Were there different stories playing out, especially with costs maybe varying globally?
Yeah, there were some distinct differences. Input costs seem to have played a big role here. The domestic subsidiaries really performed well. They reported double-digit sales growth, 11.5%.
Okay.
But their EBITDA growth was remarkable, 31.7% over Q1 last year.
31.7%. Wow.
Yeah. And the commentary suggests this was primarily driven by softening input costs in India. Lower costs directly boosted their profitability quite significantly.
Right, you can see the direct impact. Got the specific numbers for domestic.
Yeah, hang on. Domestic subsidiaries. Sales were RS's 3.1 crore, up from 115.1 crore, and EBITDA was RNS 21.7 crore, up sharply from 15.3 crore in Q1 FY25.
Okay, clear story there. What about the international side then?
International subsidiaries also grew. Revenue up 6.4%, EBITDA up 9.0% over Q1 FY25. So still solid growth.
And margins improved slightly internationally too.
Yes, EBITDA margins for international improved by 34 basis points. Not as dramatic as domestic, but still positive. However, it's worth digging a bit deeper internationally. There were some regional variations.
Okay.
Well, the Middle East and Africa region, sales grew about 5% to RSS 78.4 crore, which sounds okay. But their EBITDA actually declined by 27%, down to RSS 6.1 crore.
Sales up, profit down significantly. That's interesting. Any reason given for that specific drop in MEA?
The source material doesn't explicitly spell out why for that specific region, unfortunately.
Okay.
But typically when you see sales rise but EBITDA fall, it often points to maybe higher operating costs locally, perhaps increased marketing spend or strategic investments hitting short-term profit, or maybe a shift in product mix toward lower margin items in that region.
Right. Could be several things. Definitely something to keep an eye on in future quarters for that region.
For sure. In contrast, though, the Asia region looks strong. Sales up 7% to RS 83.9 crore.
And the profit?
EBITDA saw really healthy growth there, up 32% to RS 16.9 crore. Shows good leverage and growth in those Asian markets.
Okay, so a bit of a mixed picture internationally, but overall positive growth.
Exactly. And one other factor mentioned across the board was innovation. Continued innovation in both C&B and B2B positively contributing to the overall revenues.
Right, that R&D focus paying off. So we've touched on C&B and B2B volume growth. Let's dive deeper into the segments themselves, just looking at the standalone business. Can you break down their specific sales and profitability, and maybe remind us what exactly falls into C&B versus B2B?
Sure. Looking at the standalone segment results, the Consumer Bazaar, or C&B segment, sales came in at RS 2,818 crore. That's a 10.2% growth over Q1 last year.
10.2% for C&B sales. Okay.
And their segment results, they measure this using PBIT, profit before interest and taxes, that grew even faster, 16.1%, reaching Rs 904 crore.
Again, profit growing faster than sales within the segment.
Yes. And that pushed their PBIT margin for C&B up nicely, from 30.5% last year to 32.1% this quarter.
32% margin on the C&B side. Pretty impressive. And just to clarify, who exactly is the C&B customer?
C&B is basically sales to, well, retail users.
Mm-hmm.
But it's a wide net. Think carpenters, painters, plumbers,
Hmm.
but also regular households, students buying craft supplies. Anyone using their adhesives, sealants, art materials, construction chemicals on a smaller scale. Is that massive base of individual users and small professionals.
Got it. The everyday users, essentially. And what about the other side, the business-to-business B2B segment? How did that look?
B2B also showed really strong performance. Sales were Rs 702 crore. That's up 11.6% over Q1 FY25.
Okay, slightly faster sales growth than CMB, actually.
Slightly, yes.
Yeah.
And their PDIT, the segment profit, grew even more strongly, up 23.1% to Rs 131 crore.
23% profit growth in B2B?
Yep, which improved their PBIT margin significantly too, from 17.0% last year to 18.7% this quarter.
So healthy margin expansion there as well. And B2B caters to?
B2B is focused on large business users, so industrial products mostly.
Mm-hmm.
Industrial adhesives, synthetic resins, pigments, construction chemicals for big projects, surfactants, that sort of thing. Bulk buyers, essentially.
Right. Now, if you look at the overall split based on last year's sales, I think they mentioned, how does it break down between C&B and B2B?
Yeah, based on FY24-25 sales, C&B products made up about 81.2% of their total standalone sales. It's clearly the dominant segment.
80%. Wow.
And within C&B, adhesives and sealants alone are over half the company's sales at 53.2%. B2B makes up the remaining 18.4%.
Okay, so C&B is definitely the engine room, deeply embedded, like you said. But that B2B segment, even though it's smaller, is showing some really dynamic growth, both volume and profit.
Absolutely. It's an important growth driver, despite C&B's overall dominance.
It's clear why Pidilite is such a powerhouse. Beyond the numbers, what are those core strengths? What makes them tick so consistently?
Well, you have to remember their history. Established way back in 1959, they were real pioneers in consumer and specialty chemicals in India. And that legacy translates into incredible brand strength. Fevicol, as you said, is just synonymous with glue. It's consistently ranked among India's most trusted brands.
It really is.
But it's not just Fevicol. Think M-Seal, Fevikwik, Fevistic, Roth, Dr. Fixit, Fevicol, Araldite. These are all powerful, well-known brands in their own right. They're household names.
They've built an amazing portfolio,
Right.
and supporting that must require a huge operational setup.
Oh, absolutely. The scale is impressive. 33 plants, 31 co-makers, 8 regional offices, 5 RDCs, 47 warehouses.
Wow.
And their reach, over 5,000 distributors just in India. That ensures their products are just everywhere.
That distribution network must be a massive competitive advantage.
Huge. And underpinning it all is their R&D. They have 5 R&D centers in India, another one in Singapore. They develop products in-house, leading to this enormous range, over 6,100 SKUs, more than 800 distinct products. That continuous innovation pipeline is vital.
Right, constantly refreshing and expanding. Okay, so strong results, powerful brands, massive operations. How is management feeling about all this? What's their outlook? Mr. Sudhanshu Vats, the MD, made some comments.
He did, yes. He acknowledged the strong UVG and the healthy margins, which he noted came despite a, quote, challenging macroeconomic demand environment. So, acknowledging the headwinds, but pleased with the performance.
Okay, realistic but positive.
Exactly. Looking forward, he expressed cautious optimism, particularly for the domestic market, citing things like potentially good monsoons, steady construction demand, maybe lower interest rates, improving liquidity, factors that could help.
But cautious, so they're still keeping an eye on potential risks.
Yes, definitely. He specifically mentioned remaining watchful of geopolitical developments, the potential impact on supply chains, global tariffs, things outside their direct control.
Standard prudence, really.
Right. And he reiterated their core strategy, delivering consistent, profitable, volume-led growth, and doing that through ongoing investment in their brands, their supply chain, and their people. It's that long-term, steady approach.
That makes sense. Consistent strategy for a consistent performer. And we see those brand investments everywhere, don't we? Those memorable ads.
Oh, yeah. Their marketing is incredibly effective. Consistent brand building, award-winning ads that really connect with people, mass appeal.
And it's not just ads, right? They seem to do a lot of direct engagement.
They do. significant relationship building, especially with the end users, the carpenters, the painters, the plumbers. That grassroots contact is crucial for them. And they're also showcasing their role in modern India, highlighting their products used in big, visible projects like the Surat Diamond Bourse or the Mumbai Coastal Road.
Mhm.
It shows their relevance beyond just the household tube of glue.
Right, blending that traditional connection with a very modern presence. Okay, so bringing this all together, if we step back from Pidilite's Q1 FY26 results, what's the main story here? What should you, our listener, take away?
I think the core message is one of really robust underlying growth, that volume growth is key. Combine that with healthy margin improvement, showing strong execution even when facing external challenges. The business is resilient.
Yeah, resilience seems like a good word for it.
And then you have the shareholder rewards the special dividend, the bonus issue,
Mhm.
underlining that financial strength and confidence.
So the key takeaway for you listening is Pidilite continues to demonstrate consistent performance across its segments. The brand portfolio is incredibly strong, and management has this balanced, cautiously optimistic view while continuing to invest strategically. They're navigating challenges well and sticking to their plan. That's what creates that sticky financial performance we talked about at the start.
It really does. Which actually leads to a final thought, perhaps.
Oh, go on.
Well, given Pidilite's clear dedication to innovation, their commitment to building a more resilient supply chain, upgrading manufacturing, all these ongoing investments, how might these solidify their market leadership even further in what's becoming a more complex global landscape? Especially thinking long-term about geopolitical shifts, maybe instability in raw material prices. How well positioned are these investments making them for the next decade, not just the next quarter?
That's a great question. How future-proof are these current investments against bigger long-term global shifts? Definitely something to think about as we watch Pidilite's journey continue.